Hello and welcome, everyone. This is episode 28 of Great Quarter Guys. I'm your host, Andrew Cox. I'm always joined by Mr. Kevin Hill. How are we today, Kevin?
We're doing fantastic here on a beautiful spring day in Tennessee right now.
Yeah, we've had some nice weather the last few days.
Well,
we've been blessed. Yeah. It was a beautiful weekend. We've got a beautiful show for you today. We're going to have a split show. We're going to split it down the middle. We're going to do some earnings. We've got some more Q1 earnings for you. We're going to go over Uber. And we're going to go over USX, Chattanooga's very own. And then we're going to do some unemployment talk with Mr. Anthony Smith, our lead economist.
Yeah, our lead economist. We have some major job numbers coming out.
They've been absolutely brutal. We had the non-farm payrolls come out on Friday. Anthony and I discussed them a little bit on FreightWaves now, but we want to take a little bit of a deeper dive, get some of his insights on when we can see a recovery, when we might see some of those jobs come back, and whether it's even worth projecting these things out with so much uncertainty right now. So
true.
We'll get to that eventually.
Well, let's start with one good thing, though.
Yeah, let's start with one good piece. I had a very difficult time getting a one good piece this week. I've actually lapsed this week, so you guys are going to have to forgive me. I will come back with a beautiful one good piece next week. It's going to be the best one good piece yet, I hope. But I don't have one for you this week, but we'll get one next week. So an update to last week's long shorts. We both did. We did some long-term long shorts, so there's not much update here. But on Saya, we both were long. We think they're the fastest growing LTL, and they're no longer focused on undercutting ODFL and price, and they're really positioned well to take advantage of that West Coast recovery. And then the airline passengers, we kind of did an over-under on whether we'd see airline passengers up at least a 50% capacity of normal capacity through the end of the year. We were both short on that. That is still to come, even though we have seen them double off the bottom in the last week, haven't we, Kevin?
Oh, we have. We've seen it double off the really mid-April highs. So basically we went from about 90,000 as a low kind of mid-April to 200,000 as of last weekend, though it's Mother's Day and there's probably a little bit of a bounce there. I mean, it's doubled, but if you look at year over year on a graph, then you can't even tell it's doubled. Right. It's that far down. I mean, it doubled up to 8% now. 8% of the amount of people are flying this year than last year on each of the last few days.
Yeah, it's a really tough time for airlines. We talked about it during the coronavirus freight market update that Avianca Airlines out of Colombia, their flagship carrier, has filed for bankruptcy. The Boeing CEO came out and said that he doesn't think that's the only one. He thinks there's going to be a major U.S. or North American carrier that has to file for bankruptcy before the end of this. So it's likely going to be a long time before we see passengers reach that pre-crisis level, if they ever do again.
It is. I mean, you have. It's very difficult. You have Delta, Southwest, American Airlines all coming out saying it's a two to 3 years to get back to normal from this. And once they do come back to normal, it's going to be all three are going to be much smaller airlines going forward. So you have a lot of uncertainty there.
Yeah, no doubt. So let's hop right in. We've got Uber on the top of the docket. They'll lead us off the show. They had actually some pretty good earnings for as bad as the quarter was for many people. We'll start from the top, and then we'll go to the positives and the negatives. Just some of the overall. So the rides booking, their flagship service, which is just their Uber rides. Their bookings were down only 5% year over year in Q1, and it was a roller coaster through January and February. They were up 20% year over year, and then in March down 40%, and then in April down 80%. So a roller coaster ride there.
That is a roller coaster ride, isn't it? You have this normal high growth that Uber rides are, and then you just fall off a cliff with everybody else. And we'll see. I think they've said since then that their low points are probably on ride sharing. And it's probably right. I think you took an Uber to the office yesterday, right?
I did take an Uber to the office yesterday. Yeah, I left my keys in Nashville over the weekend, so I had an Uber to the office. And
you wore a mask.
I did wear a mask.
You wore a mask in that Uber.
And I'm not the only one that's starting to take Ubers again now. They have mentioned that they believe they've hit the bottom on most of their big markets. So for example, rides were up 14% week over week in all of the New York, Chicago, and LA markets. So they think things have bottomed there. And then another good sign is that the rides bookings in those states that have opened up a little bit, that have opened up their economy, like Texas and like Tennessee and Georgia, they're seeing a really quick recovery. They say Georgia and Texas are already up to between 40 and 50% of their respective trough levels. So that's a good sign.
Yeah, and I think I don't really have any issues taking an Uber right now. I'm just not really going anywhere. I have more issues going into restaurants and going where other people are right now than actually getting an Uber. So once I feel comfortable going in and having a nice meal again, I'll Uber there.
And that's, I'll foreshadow this one negative that is one thing that could come of this is that the Uber pool rides, we don't really have them much in Chattanooga, but some in the bigger cities, the sharing rides, those are kind of going to be taken away, which, will take away some of their demand. But I genuinely think you're right there. I think for the most part, people are going to be pretty comfortable just getting in an Uber, especially if they have a mask.
Now I do get food delivered right now. So that's Uber Eats, which had a very good quarter.
Yeah, Uber Eats had by far its best quarter on record. The bookings grew 89% year over year in April. I mean, just exploding. And their take rate was surprisingly good. It was up to 11.3%, which is the highest it's been. And Bank of America is now projecting Uber Eats bookings to be up 75% for the entire year of 2020 over 2019.
Yeah, I mean, that's people are ordering out, delivering more and more. Even as the economies open up, I think it's going to be slower than most expect. To get up back from whatever your limit is in your state, 25%, 50%, getting back up to that 100% is going to be rough for a lot of people, and it's going to take some time. So I think Uber Eats is definitely going to expand over the next couple quarters at least.
Yeah, there is. I want to hold off on our expansion talks of Uber Eats because we do have a rumor to talk about later on in the show. But we can talk about one more positive that they come away with is that this is a sad thing that we keep having to do every week, but we are celebrating the fact that management laid off 20% or 15% of a workforce just for a couple extra points of OR. But that is, of course, the case here again. There's going to be some long-term benefits of not only the layoffs that they made, but also the divestiture of the Jump platform, which was their bikes and scooters. I know you haven't been long on the idea of those bikes and scooters. They're not even legal here in Chattanooga, thanks to Ken Smith. He fought the tough battle there, getting those expelled. But yeah, I think they're going to have some long-term benefits here from that divestiture and unfortunately, the layoffs.
Yeah, I've never been a big bullish person on electric scooters, and now that you have to share them and pick them up off the street or the sidewalk and jump on them, I'm by far.
Yeah, even less or even more bearish now that I'd have to touch something after another person.
Yeah, you have to disinfect it all before you can actually even use it.
Right. Yeah, that's they need to have the little hand
go
wipes.
out and break my arm.
Yeah, right. On top of that, so let's jump into a couple of the negatives. I mean, right off the bat, it is pretty blunt and obvious that rides booking was down 80% year over year in April. I mean, that's to be expected. Let's look at the airline passengers; they're down even more than that. So retail is down considerably like that. It's just tough to see 80% down. The good thing is it has bottomed.
Do you think it'll be year over year? If take the second quarter, do you think it's going to be? Do you think they're going to recover enough to be year over year growth
through
in the
first
half
half of the year?
Yeah,
or just
20.
Well, they were only down 5% in the first quarter, so I would think that in the second quarter, they're going to be close. I mean, I think if they should be. I think they'll still be negative year over year after Q2.
I do too.
Yeah, I think it'll take. I still think they'll probably be negative year over year. I don't know.
I mean, you can say it's bottom, but
yeah, but
you're not going to have that trajectory up. It's not going to be V-shaped, right?
No,
it's going to be
it'll stay depressed for a while. Even places like Texas and Georgia, where they've had 50% recovery, Hong Kong has actually had 70% recovery to pre-crisis levels. So, and Hong Kong is fully operational; they're pretty much fully running. So they haven't seen demand climb all the way back up. So, they could be negative for the full year, most definitely. But the good thing is on their side that they've actually expanded margins. Their take rate on the rides was the highest. I think it's the highest it's been. It was at 23.5% or so. So that's good. Another bad point was they did miss on two of their critical KPIs. This is their monthly average users and their trips, and both of these grew, but they grew at the slowest rate that they've grown in a long time, to be expected.
Yeah,
obviously,
we do expect it.
And then they're going to have at least $500 million in autonomous vehicle losses this year. This is again, one of their big other bets that they're going after.
It is, yeah.
But let's get to the bull in the room. That is Uber Freight. That's what we want to talk about. That is why we're talking about Uber here. And their gross bookings, it rose 55% in Q1, so it was up to nearly $200 million, and that's, again, in gross bookings. So you take their margins are quite poor.
Yeah, it's gross revenues, right?
It's much less.
So they don't break out really their net revenues or their take rates, however you want to classify that, in their earnings report and their financials.
No, the only thing they do break out is their EBITDA, of course, for Uber Freight, and that sunk even further. So I believe Q1 of 2020 they lost 28 million. This quarter lost 64 million. So that's a run rate of $250 million.
Yeah. Q1 of 2019 to Q1 of 2020, their EBITDA was down 36%.
Yeah. Correct.
Yeah. Sequentially, it's a smaller loss than the fourth quarter.
Yep.
And I think even on gross bookings or gross revenue, it's been kind of flat for the last 3 quarters on growth sequentially, right? So you go from Q3 2019, Q4 of 2019 to Q1 of 2020. It's really no growth in those revenues.
No, and they don't really talk about Uber Eats all that much. They'll mention one thing about it on the call. No analyst really asks about it, so it's hard to get any information. Did I say Uber? Yeah, Uber Freight. It's hard to get any information on it. The only thing they did say they publicly said that they moved 10,000 loads of medical supplies and of foods at cost, which is good publicity, but it doesn't exactly help the bottom line, does it?
It doesn't. So what their take rate is, what the gross the net revenue is for Uber Freight is still somewhat of a mystery. So like the other large brokerages out there, say Robinsons, JB Hunt's, most everyone else who has a brokerage division, like our next company, US Express, they all have those published net revenue numbers, but Uber does not have those out yet.
Well, we mentioned that Uber did sell the Jump division, their scooters and their bikes, but they've been divesting things in India as well. They've sold off their Uber Eats in India. They sold off part of their business in China to Didi Chuxing. So it's been a bit of a theme here that they're selling off some of their unprofitable or at least low growth businesses. Kevin, do you think Uber Freight could be on the docket? Do they think they could be fishing for partners there? And if they were, who would even want to buy it?
It's hard to find a national buyer for them because the larger brokerages are basically they're just buying back their book of business or buying customers since it's not profitable as of yet. I think it could be on the block. I think what was the plans were for the end of 2020 to be profitable.
It's been pushed back to Q3 of 2021, which is not it's not terrible, which is how bad it could have been. But
so they definitely have to pick out in their portfolio of business segments, which ones are going to be the top performers profitability wise and which aren't, and value those accordingly. So I think it should be a scenario that is definitely looked at, and we'll see over the next few months.
Yeah, we'll see. I'm sure we're going to hear more rumors about this coming out. But one thing for me is that all of the potential buyers, the big legacy brokerages, they all have really advanced tech. I could see that people could try to maybe buy off this Uber Freight division simply to get the engineering talent that Uber has out there in California or in Chicago. But most of them, the C.H. Robinsons, the J.B. Hunt divisions, they've all got really great tech.
They have really good tech, and usually they will buy. They'll buy companies to get into that market, but they're all competing for the same market or buying cash flow, which Uber Freight doesn't produce a cash flow
exactly
right now, nor does it look like they will be in the foreseeable future. So really, they're all sharing clients too. I mean, there's the food and beverage industry. They're all sharing the same clients, moving different loads for them, competing over that. So in essence, if you're a strategic buyer, you're buying a customer list you probably already have. And if you're a private equity firm out there, you're looking for cash flow, which Uber Freight right now doesn't produce the cash flow that's probably attractive private equity. So that limits it down.
Let's talk about another company that has had a storied history with private equity and is also big in the food and bev industry. That's Chattanooga's own USX. I read one of the more brutal sell-side research notes I've ever read about USX this week. And truthfully, most of it is just about their fleet size. It seems that either their costs are a bit too high or their rates are a little too low. And when you look at their rates and compared to their peers, it seems that they're actually pretty in line with their revenue per truck per week. So most of the analysts are now looking to the cost side, that it must be too big of a fleet.
Yeah, the expanded fleet to go into the recovery,
right?
And that recovery, was a bet anyway. The recovery was a bet, certainly in the freight markets. The freight market recovery, but with COVID-19, that's kind of thrown all kind of predictions, forecasts, everything out the window. So it's time to struggle through that.
Yeah, I mean, it's a bet that really could have paid off if because we were all calling for this kind of second half or at least midsummer capacity crunch when the produce season came on and beverage goods, things of that nature really picked up. But I mean, you're right. Coronavirus has just turned the entire economy up on its head. So it's really difficult that they kind of put themselves out there for that bet, and it might not work out for them.
Yeah, the one silver lining right now, though, is that they're more exposed to the essential products, so the food and beverage, the dollar stores, that type of general merchandise that is still in demand. It's consumables, essential consumables, so that they'll keep on moving. So if they'd had a mix that was automotive or more heavily into the manufacturing segments of the economy, it would have been brutal.
Yeah, it would have been really rough. And another thing that's kind of another point that the analysts are harping on that doesn't really make sense to me that they don't really understand either is the driver turnover at USX. They said it's about 130%, which is again, it's always very high in this industry. It's usually about 100%, but they're a bit higher than their peers, which is something that they need to address as well.
Yeah, so this is something they need to address, and that's something that you can look at and gauge that number going forward into the next few quarters and see how that's moving. To see what kind of progress they have, because that's a huge expense. It hits the bottom line heavily. Recruiting costs, it costs, anywhere, industry average somewhere between $10,000 and $15,000 per getting one driver in one seat. So the higher turnover you have, the more expensive it's going to be. And as we said, it normally averages around 100% anyway. So it's very expensive, no matter what. So bringing that down is essential to increase USX's earnings power.
Yeah, I mean, for a fleet of 6,000 trucks, you can do the math on your head. If they're having to hire 6,000 or even a couple thousand drivers a year, you can see that can get really expensive.
Really expensive really quickly. Yes.
Well, let's jump ship a little bit. We're getting pressed for time, so let's bring in our main man, Anthony Smith. He is the lead economist here at FreightWaves. We're going to talk a little bit about unemployment. We of course got those non-farm payrolls data in for April back on Friday. It was one of the worst non-farm payroll reports on record. It's not that we were surprised by it, but it's really brutal to see.
It went from around 3.5%, which was one of the best in history.
Yeah, 50-year low.
To the worst in a matter of
8 weeks.
8 weeks.
Yeah, absolutely insane. But let's hop over to Anthony. Anthony, you want to give just a little overall on what your takeaways were from the non-farm payrolls? What sectors were hit the worst? Which do you expect to recover the quickest?
Yeah, definitely. Just as you guys mentioned, this was one of the hardest hits that we've ever seen in the history since this has been recorded. Of course, I think this was something that we've expected as we've seen the jobless claims really pile in over the last few weeks. Not too much of a surprise. The hardest hit industries, of course, leisure, hospitality, well over a 40+% decline since the beginning of the year. Of course, that's going to be a hard hit one, and that's going to be one that's probably a little bit slower to come back. Construction, another hard hit area, manufacturing. We did see that there was some decline in financial services, but wasn't hit quite as hard as many of the other segments overall. But when we're looking at jumpstarting the economy, I think, or any type of recovery, of course, I think we're going to start to look for many manufacturers to probably come back online. When we're looking at different manufacturers, automotive, definitely one of the hardest hit, but we are starting to see sparks of them starting to come back online for sure.
Anthony, when do you think, is it even fair to project out when we think we could get a full recovery of these jobs? There's so much uncertainty now. Is it even worth the time to point out when we think we can get there?
So that task would be very difficult. I like to look at things on a macro scale, and for that macro outlook, it's going to be difficult. But if you really are looking to really kind of forecast and really get an idea of when things are coming back, it has to be done on a state-by-state basis. When you're looking at which state their core competencies are, what really drives their economies, you're going to have to look at what their population is looking like, what their current coronavirus situation is looking like, what the governance is looking like, and what kind of ordinances are being put in place. So, for example, we've heard of stories in places like Hawaii, which is a huge hospitality hub, really being able to really struggling with being able to quarantine and really taking things very seriously. They're most likely going to be a little bit more strict on things coming back online, really ramping up their self-quarantine measures, as opposed to areas like here in Chattanooga, where some restaurants, or many of the restaurants, are starting to come back online already, and you can start to see, tables being seated, maybe every other table or so, just as long as the staff are wearing masks. But really, when we're looking at this, if you want to forecast it, if you want to look at it, and really kind of project when these jobs start to come back online, it's definitely going to have to be done on a state-by-state basis, just because there's so many regional variances.
Yeah, I agree with you, Anthony. I think that's a really good point. What do you make of I guess one of the most surprising points of this report for me was the average hourly earnings actually jumped almost 5%. I see that and I look at it as a lot of the jobs that have been taken away were low income jobs. So you have the higher income jobs that remain are pushing up the average. What do you make about this?
I agree. I think you're definitely on track there with some of the higher income jobs definitely staying online when you're looking at those that are able to telecommute also. When you're looking at this, just from a statistical point, you have fewer people to really do that comparison with when you're dividing it out. And so that definitely kind of makes sense to me. One of the other things that kind of makes me think about is, of course, the incentivization for some individuals. I know we chatted about this shortly on one of our other segments, but incentivizing some individuals for remaining unemployed, because many people are making more than they were when they were employed on unemployment. So there's that kind of incentive for many individuals to shelter in place, continue to stay at home, social distancing, practicing those measures, because they're actually making more now and having more income now than they were when they're actually working.
Yeah, that's going to be something to watch here when we get towards the end of this containment or into this social distancing measures, is if they're going to have to extend those additional benefits, or if they're going to try to force people back to work. But one question I had for you, Anthony, was, do you think this 14.7% in April is the peak of our unemployment rate? And if it's not, when do we see the peak, and how high do you think it can go?
I think we can definitely start to see numbers get into that 20% range. So I don't think this is the peak just yet. Although some economies are starting to come back online, I think when we start to get May numbers, we might start to see a little bit more piling on. May, June might be when we see those peaks between one of those 2 months, potentially, and then we might start to see some subsiding there. I'm going to keep my eyes closely on continuous job claims, because initial job claims really shows when those first claims for unemployment and benefits come in for first-time filers, but continuous claims are those that are continuously claiming on a week-to-week basis, so they have yet to find employment. So that's going to be really a key area to watch, to really kind of see if there's any kind of subsiding for those unemployed individuals. Also looking at the 4-week moving average for weekly jobless claims is going to be something to watch. I think it's still just over 4 million, so it moved down a little bit, but still that's going to be one to watch. It's starting to subside. I'm hoping to see continuous claims come down, but really I think we haven't seen our peak just yet. But it's going to be interesting, because when we look at unemployment numbers, the area that gets factored in is those that are discouraged and no longer looking. And so that's going to be another interesting way of how things get measured and divvied out when we look at the recovery side of this thing. Kevin, maybe as you know as well, when we've seen any kind of policies that are being put in place, even if there is a deadline for things to stop, it's not always that clear cut for many government policies and things like that when we have rollouts for any kind of benefits in the government. You want to be able to help and aid and assist, but it's really difficult to really reel those in sometimes.
All right. Well, Anthony, thank you so much for your insight, man. I'm sure we'll see you tomorrow on Freightnomics with Zach Strickland. Thank you again so much. All right, so Kevin, let's hop into our last few minutes here. We can touch quickly on the DHL supply chain pricing power index from last week. We didn't have much movement. It actually stayed at 10. This is again the battle back and forth. Strickland is seemingly losing his 9,300. Great debate right now, but volumes are still pretty depressed. And rejection rates have found a bottom, but they're still below 3%.
Yeah, so the volumes, OTVI has recovered quite a bit. We're over 9,400, I think, as of today. So that's a very encouraging sign. And as you said, the tender rejections, which is our measure of capacity in the market, has hopefully bottomed. I mean, I don't know how much lower it could have went, but it really isn't doing much. It's staying at very depressed levels, below 3%, which means that even with volumes coming up, that pricing power is really not there yet for carriers. Hopefully that's a lagging indicator, and that will turn over. May 18th comes around on Monday, and that's when auto manufacturing opens up. Right. Hopefully everything goes well with that there is demand for manufactured goods. We talked to Dr. Jason Miller earlier today on the coronavirus freight market update, and that's one of the questions, and going through the worst case scenarios and best case scenarios of the demand for manufactured goods. So we will see how that plays out. But right now we're holding steady at 10 and waiting for new information that's coming through this week.
Yeah, I think we will have a movement this week. But let's go to our last segment. Let's jump to the long shorts. I know we're going to have some movement here. This will be fun. Yes. We're gonna dive into the rumor mill here a little bit. I have found some hot rumors on the internet about some M&A activity going on in this very odd time. But the first one is a little bit more far-fetched, and we'll go to it, and then we'll go to the more realistic one in a second. But the very far-fetched one is, the rumor has it that Amazon, the big, massive Amazon, is kind of circling around like sharks in the water around AMC Theaters, the nation's largest theater company. They own 6,500 theaters in the U.S. and Europe. Kevin, can you think of a reason why they would do this, and are you long or short the idea of them doing it?
I can't think of a really good reason to purchase AMC movie theaters, except for maybe the real estate. I guess you could cross-sell it. We talked about it a little bit because you brought it up earlier this morning. You could cross-sell a little bit. You can stream your own original content in there. But it's hard to make a case. I mean, you can buy it really cheap right now, which is always good. Everyone loves things that are on sale. So Amazon has enough money to buy it and just to figure it out from there. And if crowds come back, if movie theaters come back, they could put their own interesting spin on it. You brought up Prime membership. So I would kind of like to go short, but it's such an insignificant buy for Amazon. It's hard to go short. I have to go long. Yeah,
it's just pennies, isn't it? Yeah. I mean, their market cap is over $1 trillion. AMC's is the low single digit billions. I mean, it doesn't really make all that much sense financially, but it does kind of make sense in the fact that, okay, they can give it it's so little money for them that they could give it a test, and if it doesn't work out, then they just shut the movie theaters down and reduce, and they take away some competition for their streaming. I mean, they help out their competition with Netflix in that sense, but I do think there is some cross-selling there. They could sell Prime memberships to movie theaters where they can watch either Amazon movies or regular movies are in there, because there is still a demand for going to the movies. I mean, as much as streaming has taken away a lot of the demand for streaming, there is still something about, for me at least, going to the movies and experiencing something in theater. And while we can't do that right now because of the coronavirus, but we will eventually be able to do that again, and I think people are going to go back to the movies.
One of the strange things is then they're going to get into a battle with Hollywood, with distribution, and that's something else that has to be worked out. Remember the music industry and its long battle with internet. From Napster to Apple iTunes and Amazon streaming services, right? That whole big battle. So I don't know. I mean, it'd be like Amazon going and buying a Snickers bar, though. how much money are you really going to waste on it?
Yeah, I mean, it kind of
There's
reminds
not
me a
gonna
little
be
bit of Ted Turner owning the Braves and owning the streaming and owning the network. It's kind of like they own both sides of the coin. They can either stream things online or they can own the theaters. I see that being a play, but I don't know. I'm kind of shorted as well. But we've got one more that is seemingly a little bit of a more probable rumor here, and this one is that Uber is looking to acquire Grubhub. So this would unite the two largest food delivery companies in America. Uber is now worth their market cap's over $50 billion. I think Grubhub's is about $5 billion. So it would be a small add-on purchase to them, growing about 10% by market cap. Kevin, are you short or are you long the idea of Uber snatching up Grubhub?
Well, that industry's got to consolidate because margins aren't there. They're all competing with each other. The race to the bottom of who can lose the most money on food delivery. So there's got to be consolidation. So I'm along that.
I'm long it too. I think it makes a lot of sense. I think that Grubhub's the number one competition for Uber, yet they're minuscule in size. I think it gives them. It gives them a lot of network density where they can get a lot of the restaurants that they hadn't signed up for already. There's a lot of cross-selling opportunities there between Uber and I think it's a really good move for them. I hope they do it. And yeah, I think I'm very long that idea. I think it's gonna be great.
Yeah.
But that about wraps it up. Let's go ahead and put in our plugs for the day. What you got going on tomorrow on Put That Coffee Down with Tim Dooner?
We have Bill Vitti from truckstop.com coming in, and we're going to talk about how to align your sales goals with the sales team and the company. Sometimes they don't really match up all that well, and the importance of making sure that everything flows as it should.
Very nice. And then, of course, we've got a bunch of other shows coming up this week. We've got Freightonomics coming up with our man Anthony Smith, who we just spoke to, and Zach Strickland. Then we've got with Sonar on Thursday, and then What the Truck to round it out on Friday. And another coronavirus market update on Thursday. So
on Thursday
make sure to tune into that. But this has been episode 28 of Great Quarter, guys. We're on a 6-day, 23.5-hour break. See you guys next week.